Profits are not a beautiful line. I call it the peak and valleys. You can call it the bell curves, whatever you want. When you get close to maxing out your current, and this is the way it works, and it's kind of a mental game, but let me explain it. When you max the current version of your business model out, that is when you'll be most profitable. Hi, this is Coach Joe Lucas, and welcome to the Magellan Network Show. My goal inside of this communication, this show, is to share with you my nearly 30 years of coaching some of the most successful financial advisors in North America. We're going to be talking about strategies, syntaxes. We're going to be bringing guests on from time to time, and I'm going to share with you what's working now. So think of this show as sort of like a little one-on-one kind of mini coaching cast, if you like, where we're going to be going in depth from time to time on strategies to help you grow your business, get more effective, become more efficient, find balance in your time management, grow your business, and quite frankly, whatever else is going on in the world today. So before we get to today's episode, I'd love for you to do a couple things for me. Number one, make sure that if you're watching this on YouTube, that you subscribe to our YouTube channel. If you're doing the audio, make sure that you give us a review on whether it's Spotify or Apple. We'd really appreciate that. And quite frankly, that does help. It does matter when you rate things and like things and subscribe to things. It helps us get the word out to more of the industry. And lastly, I have a very special gift for you. Go to MagellanNetwork.net, so one word, MagellanNetwork.net, and I have for you a complimentary membership, 100% gratis, where you can tap into about between 50 and 75 hours of masterclasses, forms, tools, templates, and strategies. So please go ahead and make sure you go ahead and get that claimed. Smash the like button and subscribe. And please go ahead and leave us a review on whatever podcasting platform you're on. And now, let's get to this week's episode. Hi, it's your coach, Joe Lucas, and welcome to this episode of the Magellan Network Show. And season's greetings here, December 2023. And what a crazy year in this business. In this episode, what I want to do, last episode, we talked about why advisors fail to grow. So in this episode, I want to kind of peel that back a little bit and talk a little bit more about money, cash, profits, and why this is a massive blind spot for most advisors, even though you're in the money game, right, when it comes to your clients. So if you think about it, what does an advisor need to grow? If you look at our last episode or watch it, obviously we talked a lot about mindset and vision and so on, but there also is another component of that, which is what we call resources. And resources are code for cash, right? Profits. And in this industry, depending on how you entered into this game, you were taught, if you've been around for any period of time, we all know the advisor economic syndrome, right? Which is basically, oh, I made $1 million, so let me go spend $1 million, right? Or I'm netting $500,000, so let me go have a $500,000 a year lifestyle. We laugh about it, right? A lot of you remember this conversation you've had with yourself when you got in. Man, if I can just make $100,000 a year, I'll be good. And then you get there and you're like, that is not nearly good enough, right? Then you get to 200, then 300, 500. And you have this lifestyle creep that is literally it's right behind you in your economic game. For most advisors, I know there's some of you that are very good stewards of your capital, very good business mindset. So obviously you're ahead of the game here, but that is in the stark minority of advisors. So what happens is, there's going to be times on a regular basis when you're going to have to reinvest back in your business, right? And let's face it, there's two kind of avenues of reinvestment. There's people, right? People, which are by and large going to be the most intense investment you're going to make, i.e. the most expensive. And then there'll be other capabilities, right? Maybe there's a marketing capability. Maybe there's a technology capability that you're going to be looking for. But here's the thing, and I hear this often. I've heard this actually too often in my career. oh, Joe, yeah, I need to get some. I don't have the money right now. I go, let me get this right. I said, you're rolling at $1 million top, let's just say $500,000 net, and you don't have any capital to go get a part-time assistant or to add another assistant, or let's start recruiting for a junior advisor or doing client, like how do you not have that? And they'll fess up and say, well, we did this with some of the money. I got this. My overhead is X and stuff like that. What you don't realize, and I'm hoping for some of you who are newer in this game, this will 100% resonate with you. You never, ever, ever, and I'm not saying there's a rule, like it has to be this, but I'm going to give you kind of what I normally talk to my clients about, okay? So if I'm going to use the example of $1 million, $500,000, but you can, again, extrapolate up or down. It all works the same. So if you have $1 million practice and you're netting $500,000, and when I say net, you still got to pay the tax man too. Let's not forget that. You always want to have a cushion in my mind. So if you have $500,000 of income, or profit, let's use the word profit, it's probably better here. So if you have $500,000 of profit, which will pay yourself, pay your taxes, and so on, you always want to have at least $100,000 to $200,000 cushion. So not maybe living on half, but maybe live on 2/3, right? Have a 2/3, call it the 2/3 lifestyle if you like. Why? So you have capital to take advantage of opportunities. So let's say, for example, because I had this recently, I had a client, they were approached by another advisor in their OSJ who's getting ready to retire. And he said, look, I'd love you to be the one to take over my practice because he has no family, there's no succession, and so on. And it's a pretty sizable thing. And, we're going to need to come up with some money down. But luckily, because it's been a client of mine for many, many years, actually a decade and a half, we have this, this war chest, if you will, of capital that, we can definitely stroke a check for the down payment. We can get an entity to finance the rest. And we're good to go because unfortunately, he's gotten ill. The seller, and so it's not going to be like a 3-year deal. Like we're going to have to get this done first half of 2024. If he didn't have that rule about retaining earnings, for lack of a better word, we wouldn't have the resources to go make this happen. We can go borrow it, I'm sure, but then we'd be really leveraged up, right? And we all know what interest rates look like today. So treat yourself as a business. And make sure you're always, quote unquote, retaining some, even if you're a W-2 at a major firm, I understand that, always have some retained earnings. Always have a bit of a war chest for a couple of different reasons. Number one, markets go up, markets go down. You want to always have that, you always want to have that cushion in your operating account. We all know, I always laugh, like, what's your number? And when I ask an advisor, like, what's your number? They go, what do you mean? I said, well, in your business operating account, what's the number that, as long as it's above that number, you feel really, really good about things. And if it goes below that number, like, you don't feel good about things at all. And they kind of laugh. But it's funny. Everybody's got a number. Also, you want to have resources available. So let's just say a rock star assistant becomes available for whatever reason, right? And even though you might be a little early in kind of when you might need that person, but it's absolutely the right person. If you don't have that, if you don't have those economic resources, you're going to tell yourself, oh man, this is really good, but I can't afford them right now. And you're going to miss out on that talent, that capability. So when you're doing, and this is the perfect time to talk about this. So as you get into your 2024, there are a couple of what I'll call line items I think you need to account for when you're doing your budgeting, when you're doing your P&L, when you're coming up with your game plan, and I hope all of you are doing budgeting. So number one, 10% of either gross or net. You can play the game there, or you want to do 5% gross, 10% net, that's fine. That is going to become your personal development game plan budget, okay? I'm going to take that 10%. And I'm gonna reinvest back in myself with coaching, training, personal trainer, whatever you need to do to improve yourself, you're gonna do that. All right. The next item you're gonna have, and I'm gonna give you a number, and it can move around. Again, don't ask me about industry averages, by the way, because in my mind there really isn't any, because people do all kinds of stuff. But 3 to 5% of a household's income. So hear me out on this. It's really important. Hi, Coach Joe Lukacs here, and I'm just breaking here for a moment Just to do a couple quick reminders. Number one, make sure you subscribe to our YouTube channel or our podcast. In addition, please leave a comment or a review. Those things really, really matter. And share this episode with 3 of your colleagues inside the financial services space. And lastly, make sure that you go ahead and claim your free membership inside of Magellan Network. Now back to this week's episode. So let's say you have a household that throws off, let's just keep them at $1 million household, $10,000 net, keep them that simple, right? Or 10,000 gross. Obviously, 10% of that would be 1,000, so 5% that would be $500, 3% would be 300, obviously. So somewhere between $300 and $500, you would want to put in what we call the goodwill budget for gifting and events and just doing nice things, building what we call that relational capital. Like really have a gifting relational capital strategy. I know some of you can say, oh, Joe, but I got this FINRA thing and we're limited. Okay, fine. The gifting side I get. Do educational seminars. Do educational seminars like beautiful and nice restaurants with great meals, right? Reinvest back in your clients. We all trade on goodwill. Okay? That's the second thing. Then the third thing is what's the line item to marketing, right? So biz dev marketing. I'm going to say, I think the last data I saw, this is a couple years ago, it was an article actually. I don't forget where I read it. It was about Ken Fisher. We're not going to get into that. But I remember that they took I remember what really stood out to me is they took 4% of gross revenue, and that's what they used for the marketing. Now, 4% doesn't seem like a lot, but if you're rolling, $50, $75 million top lines, 4 points, that gets interesting, right? So I would love for you, and the reason why I like ratios, by the way, let me explain this too, versus hard dollars. If you do hard dollars, your brain's going to say, oh man, that's a lot of money. Right? But if you sit there and say, okay, hey, I got $1 million gross, so 5 points for me, that's $50K for personal development. I'm going to take 4 points on $1 million, that's going to be, what's that going to be for? Whatever it is, right? 4% on a client, I'm going to go put that in the bucket. And then I'm going to take maybe 4 to 5%, and I'm going to use that for my marketing budget, right? And then as your business grows, guess what? You have more capabilities, more capital. You actually go faster the bigger you get because you have the resources to deploy, okay? So the bottom line is, and let me say this too, that profits are not a beautiful line. I call it the peak and valleys. You can call it the bell curves, whatever you want. When you get close to maxing out your current, and this is the way it works, and it's kind of a mental game, but let me explain it. When you max the current version of your business model out, that is when you'll be most profitable. Why? Because you've maximized the capabilities of your current resources. So while your bank account, your margin's the greatest, your stress level is also the greatest, by the way, because you're maxing it out. And so to get to that next level, there's going to have to be an investment. Typically, it might be another assistant, maybe a team advisor. There's going to be it's a lot of times going to be a human being, right? And we know humans in this game are if they're really good, they're not cheap. So you go hire somebody for, let's say, $150,000. Well, now your margin temporarily is going to go. It's not going to go to zero, but it's going to go into the valley. Okay, you got to be prepared for that, and that's why you can't redline your personal world economically. You're going to feel a lot of economic stress, and when you feel a lot of economic stress, you're going to be impatient. When you're impatient, you're going to make bad decisions. When you make bad decisions, quote, bad things happen. But when you can anticipate that and you put it into, in our planning, we do 10-year, 3-year, 1 year. So when you get that into like your 3-year window, say next 3 years I'm going to have to hire 2 people. I'm going to need a part-time admin. I'm going to have to bring in a team or junior advisor. It's going to be salaried, right? W2. I'm going to allocate $200K for both those chairs. I won't need them for another year and a half, but I know it's going to be in the 3-year budget forecast. Well, now you create certainty. And if you're a planner, isn't that what you want? I mean, it's fascinating. This is just, I'm going to take a little sidebar for a second, then we'll get you guys out of here. It's always fascinated me how advisors can be brilliant financial planners to their client. Solve, cash forecasting, retirement income cash flow forecasting, all this stuff. And then I ask them about their business, and they don't have a clue on margin, what the cost to hold the house. I mean, basic stuff. How many clients you have? Some people don't know, which blows me away. What's the cost you have? What's the cost you to have a household? No idea, right? What's your margin on your household? No idea. What's the cost you do this? What kind of RMD leak do we have? So in other words, how much money is coming out that we don't recapture when we do RMDs, right? So we scrape in 3%, 4%. And look, as your clients get older, that scrape is going to increase every year. We all know that. But if you don't know what it is, how do you anticipate it? Like right now, I mean, most of you have the capability to go out 5 years and look at your clients who are taking RMDs and extrapolate out how much RMDs are going to leave in, let's say, even 2030. Like, what's going to come out of the business? Like, we all got to become better stewards of our capital. So the bottom line here is if your lifestyle is even with your profits, you have no margin, no cushion to redeploy back in your business. So personal development game plan, client gifting, marketing, and then quite frankly, there should be another line item called retained earnings. Hey, we're going to take X amount of dollars, always put on the side here, have it in not our operating account, but maybe our capital account, where, hey, we're going to hold this for a rainy day. It's like our own personal line of credit. And, you're going to create a lot of certainty in your game, not be stressful. And the last thing I'll say for some of the younger advisors I know, watch me or listen to me. Don't get caught up in the instant gratification game. I did early in my career, and it really hurt. Okay? You don't need the vacations, you don't need the cars, you don't need the house immediately. If you can delay even just a couple of years, I'm not talking about like delaying it for a decade, but if you can delay it, let's say 2 or 3 years. So instead of getting the Mercedes this year, you wait 24 months and you take that and reinvest it back in your business, you can get trust me, you get a much nicer car. It's just you got to get that mindset of playing the long game. It's a psychology, ultimately what it boils down to. So just make sure as you get ready to start doing your 2024 planning, you're wrapping up 2023, that you really look at this and make a commitment to know your numbers for 2024. Go back and I'm not saying I want you guys working on the holidays, but if there is a worthwhile project, understand your money game personally. And I'm going to close with this. 3 questions. Number 1, do you have a personal financial plan? Number 2, do you have a business budget? Number 3, when was the last time you looked at your P&L? And I don't care if you're a W-2, 1099, run a multi-billion-dollar RIA, you need to know your numbers. Okay? So, happy Friday. Thanks for listening and watching this episode of Magellan Network Show. And I'll be with you next week before the holiday really kicks off. So I'll see you next Friday, and season's greetings. Thank you for watching or listening to this episode of the Magellan Network Show. Hey, if any of this resonated with you, I invite you to come to MagellanNetwork.net, and we have a powerful group coaching community of like-minded advisors. Come in for a trial. You and I will have a one-on-one conversation. Let's see if I can help elevate your game, both personally and professionally.